To begin, welcome to our deep dive on the capital gains trap, where we'll explain why selling assets can cost you up to 23.8% in federal taxes, and, more importantly, how strategic planning can sometimes reduce that to zero. We will explore how capital gains flow into your income, how marginal tax rates actually work, where long-term capital gains sit relative to ordinary income, what the 3.8% NIIT surcharge does, and how the QSBS exclusion can potentially eliminate millions in taxes. Let's get started. Next, here is our roadmap. First, we will define how capital gains are treated as income and flow into AGI. Second, we will demystify marginal taxation, emphasizing that only the top portion is taxed at the higher rate. Third, we will show you how long-term capital gains stack on top of ordinary income. Fourth, we will uncover the net investment income tax, the additional 3.8% many overlook. Fifth, we will cover QSBS and its powerful exclusion potential. Sixth, we will present a practical checklist and action plan. Finally, we will test your understanding with quick quizzes. Before we dive in, a quick but vital disclaimer. This content is for educational purposes only and does not constitute tax, legal, or financial advice. Tax rules and thresholds change over time and can vary by filing status, state, and year. Your personal circumstances will drive different outcomes. Consequently, you should consult with a qualified tax professional or advisor before making decisions. To start with fundamentals, when you sell an asset, your gain equals sale proceeds minus your cost basis. That gain is counted as income and included in your adjusted gross income. Because AGI is a key driver for many calculations, a larger AGI can affect your deductions and credits, and can also trigger surcharges such as the net investment income tax. The diagram shows the flow from selling an asset to the gain being included in AGI, and then influencing other parts of the tax return. Now let's clarify marginal rates to reduce anxiety. Only the top slice of your income is taxed at the higher rates. If your gain nudges your total income into the next long-term capital gains bracket, only the portion above that threshold gets the higher rate. For instance, if $50,000 of your gain pushes you into the next bracket, just that $50,000 is taxed at the higher rate, not the entire gain. As an action step, consider modeling your sale in increments to visualize precisely where marginal increases start and stop. Moving on, long-term capital gains stack on top of ordinary taxable income. Long-term treatment applies when you hold an asset for more than 1 year. If your wages, interest, or business income already occupy the lower capital gains bands, your additional gains may be taxed, starting at a higher marginal rate. A useful planning lever is to reduce ordinary income in the year of the sale, when feasible, to open up lower long-term capital gains bands and reduce your marginal rate on the sale. Furthermore, many higher-income taxpayers face the net investment income tax, an extra 3.8% on net investment income once specific thresholds are exceeded. This means the effective top federal long-term capital gains rate becomes 23.8%, not just 20%. Therefore, plan ahead by modeling your NIIT exposure and consider methods to reduce net investment income or adjust timing to mitigate the surcharge when appropriate. Additionally, before any major stock sale, investigate whether your shares qualify as qualified small business stock. If the shares meet strict criteria and are held for at least 5 years, federal law may allow exclusion of substantial amounts of gain, potentially in the millions. The primary tests include original issuance to you, C corporation qualification, gross assets of $50 million or less at the time of issuance, active business use at 80% or more, and a 5-year holding period. If you are short of the 5-year mark, a Section 1045 rollover may preserve QSBS potential by reinvesting in qualified replacement stock. Now let's compare short-term and long-term capital gains. Short-term gains occur when you sell an asset held for 1 year or less and are taxed at ordinary income rates, which are often higher. These gains stack within ordinary brackets and offer limited planning once the sale is executed. In contrast, long-term gains arise from assets held for more than 1 year and benefit from preferential capital gains rates at 0, 15, or 20%. Long-term gains sit on top of ordinary income and enable strategies like managing brackets and pairing with charitable planning. After that, use this essential checklist. First, check your holding period, because qualifying for long-term treatment can significantly reduce taxes. Second, Verify your basis by including all transactional costs to minimize your taxable gain. Third, model the marginal effects, remembering that only the top slice pays higher rates. Adjust timing and sale amounts accordingly. Fourth, assess potential net investment income tax exposure. Fifth, investigate whether your shares could qualify for QSBS and its powerful exclusion. Finally, consult a tax strategist for tailored, proactive planning on high-value transactions. Next, execute a clear action plan. Gather documents including purchase dates, cost basis, improvements, and transaction fees. Project your annual income, including wages, business income, deductions, and other investments. Then model scenarios such as partial sales, installment schedules, or bunching deductions. Aim to free up 0 or 15% long-term capital gains bands by strategically lowering ordinary income. Stress test potential NIIT exposure by mapping where thresholds could trigger the 3.8% surcharge. Evaluate QSBS early by confirming C corporation status, original issuance, the $50 million gross assets test, and your holding period. Finally, coordinate with your CPA, attorney, and wealth planner to time and execute effectively. Meanwhile, use a pre-sale planning timeline. Starting 24 to 18 months out, confirm entity status, maintain records, and begin the QSBS review. From 18 to 12 months, verify basis, model income, and identify low-income windows for potential sales. During the 6 to 3-month window, explore charitable strategies and tax loss harvesting. In the final month, finalize your sales structure and set an estimated tax and withholding plan. Post-sale, reconcile your projections, make necessary payments, and adjust future estimates. Early planning widens your choices and reduces unpleasant surprises. Now, a quick check for understanding. If a capital gain pushes you into a higher long-term capital gains bracket, which portion is taxed at the higher rate? Option A, the entire gain. Option B, only the portion above the bracket threshold. Option C, half the gain. Option D, none of it. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, only the portion above the bracket threshold. This reflects marginal taxation, where only the top portion of income is taxed at the higher rate rather than the entire gain. Next, another quick quiz. What does the net investment income tax do for many higher income taxpayers? Option A, lowers the long-term capital gains rate to 15%. Option B, adds a 3.8% surcharge on certain investment income. Option C, eliminates all capital gains tax. Option D, applies only to wages. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The net investment income tax adds a 3.8% surcharge on certain investment income for taxpayers over specified thresholds, effectively increasing the top long-term capital gains rate to 23.8%. Before we wrap up, remember these key points. Capital gains flow into AGI and affect many parts of your return. Only the top slice of income gets taxed at the higher rate, so model your sale incrementally. Long-term capital gains sit on top of ordinary income, so reducing ordinary income can open lower capital gains bands. The net investment income tax may add 3.8% for higher earners, so forecast it in advance. Finally, QSBS can exclude substantial amounts if you qualify, so review eligibility early and thoroughly. Finally, here is your summary and next steps. Understand how gains flow into AGI and influence your overall return. Use marginal taxation to your advantage and avoid assuming the top rate applies to the entire gain. Stay aware of stacking dynamics, where ordinary income fills lower bands and long-term gains sit on top. Forecast the net investment income tax and mitigate it when feasible. Investigate QSBS as early as possible and confirm the necessary tests and timelines. Then, execute a documented, advisor-led plan to optimize outcomes. As a final note, thank you for watching. If you found this valuable, please like the video, share it with someone who is considering a major sale, and subscribe for more practical wealth strategies. Comment with your questions or scenarios, and let us know what topic you want next.